Just in case you missed it, TeleDoc Health Management presented at the JP Morgan 4th Annual Health Conference, Monday on January 10th. Moderating your presentation was Lisa Gill, Managing Director and Senior Equity Analyst at JP Morgan. And if you listen in on some of the past TeleDoc quarterly earnings calls, you've probably heard Lisa asking very, very good questions of both Jason and Mela to follow up on the call. The TeleDoc executives presenting at this particular conference was Jason Gorevic, CEO, and Mela Murthy, CFO. Welcome to MGA Investing. My name is Dee. Today's short recap of Monday's presentation will cover, in summary, a few takeaways from that presentation. It's one thing to be big, but it's another thing altogether to be able to leverage that size, which is exactly what TeleDoc has been able to do and do so much more efficiently that have allowed them to deliver better outcomes and better experience for the consumer, as evidenced by their Net Promoter Score of over 60 and number one again in the J.D. Power rankings. According to Jason, in a preliminary view at least of the numbers, it looks like TeleDoc brought in some $2.03 billion in revenue in 2021 and had 14.7 million visits in 2021. Jason mentioned that he feels very comfortable with the outlook that they've given, delivering over 700 basis points of margin expansion over the last couple of years, and having done that while substantially expanding their revenue per member. He also reminded shareholders as well as analysts that something of the magnitude of TeleDoc isn't built overnight, and that they've been building out these capabilities for many years, something that gets lost in the discussion of TeleDoc. What I also like is that Jason also talked about the importance of building out a whole person offering that has the ability to be the front door for all populations and all of our population's healthcare needs, and becoming the default first stop for the consumer mental health and physical health needs. The fact that when you look at a person's blood pressure, their weight, and their mental health, they're all connected, right? They're all connected. And when a provider understands that dynamic, better care can be delivered, yielding better outcomes at a lower cost, essentially allowing the doctor and the patient to connect the dots between all the patient's healthcare needs. Data science and applied health signals are at the heart of creating a consumer that's more engaged and feels more empowered in their healthcare journey. And that's a key to unlocking better health outcomes. This, if TeleDoc can pull it all off, will be a game changer in a real sense in the healthcare industry. This will allow the patient, the consumer, to take a more active rather than passive role in their healthcare journey throughout their life. Data can be used to complete intelligent referrals for some that are pre-diabetic or pre-hypertensive, or matching the consumer with the right provider, especially as it relates to mental health care. In terms of financial growth, Jason hit a few key points as he discussed TeleDoc's multiple paths to drive growth. The importance of adding new people to the platform through client additions, and also providing more valued, usable services to existing clients. This is what TeleDoc describes as land and expand. That's the ability to get a foothold on that client through superior offerings and service quality, then adding more products to each client. Now, he also mentioned TeleDoc's increased engagement and enrollment among TeleDoc's existing members. In the U.S. alone, TeleDoc has 76 million individuals with access to its telemedicine solutions and another 60 million lives with clients contracted for its chronic care solutions. So think of that as a combined 92 million people who have access to its solutions. Think about that. That's 92 million people to engage and land and expand. Of the 92 million total lives, over 80% have access to TeleDoc's general medical solutions. You have to remember the adoption of TeleDoc's next generation virtual primary care solutions has really just started. This provides TeleDoc with a tremendous runway for things like Primary 360, My Strength Complete, and of course its chronic care solutions, where they have early stage penetration, generally 20% or less in that massive opportunity. Now, you have to think all of this translates into greater revenue per member. Think about it. It was only a few years ago that TeleDoc was in the low single digits of product penetration. Today, it sits with 40% of its clients having more than one product within the TeleDoc portfolio. Today, 25% of TeleDoc members now have access to 3 or more telemedicine solutions. Its chronic care enrollees now have roughly 1 in 4 members enrolled in more than one product versus less than 3% back in 2019. Teladoc's growth outlook it laid out in its Investor Day just a couple of months ago is 25 to 30% a year for the next 3 years on the top line, with the revenue expectations approximately $2.6 billion in 2022, which yields over $4 billion in revenue by 2024, over $100 billion of operating cash flow year to date through the third quarter of 2021, all pointing to the fact that they are the virtual care industry leader, not just in the U.S., but globally. The fact that fourth quarter bookings were up 35% over the third quarter and up 25% versus the fourth quarter of 2020, which was a very strong year for the company. Retention rates for the company have stayed incredibly high in the 90s because, as important as it is to add more clients, retention is paramount to consistent revenue and leverage on that whole land and expand concept. And 50% of his new bookings were multi-product sales. Now I want to transition to cover some of Lisa Gill's questions after Jason's presentation. Lisa Gill's first question is there any kind of pressure that's put on the margin today because of some of the factors surrounding, staffing and physicians in the marketplace? Lisa had another question regarding competition. She says, do you anticipate that there'll be more health plans that will buy or build something themselves? She mentioned the fact that Cigna now owns MD Live, and do you think that that's really going to shift or cause any change? Jason, in his answer, pointed to the importance of TeleDoc focusing on maintaining its leadership and extending that leadership position by building the broadest suite of solutions in the marketplace and by continuing to invest to expand upon that lead. Economies of scale, right? That's currently their durable competitive advantage that I talk about is so critical when investing in a company. It's what provides added protection to an investor's possibility of a future solid rate of return mid to long term. It's their moat. Jason goes on to say that clients are looking for partners who can bring a full suite of virtual care solutions, as evidenced based on Teladoc's relationship with Centene and Aetna and Aon for virtual primary care, where it brings its primary 360 product to bear for each of these clients, which allows each to build an entire product and benefit package around it. Jason mentioned again, you can't do that with a point solution. This allows the clients to further and more efficiently exploit their core competencies to further the growth of their business rather than focusing on things they're not particularly good at or care to be. Now, Jason made an important point here when he said other payers aren't super interested in relying on a competitor for that kind of strategic role in their products portfolio. And so when he thinks about Cigna, for example, buying MD Live, he felt it was actually very positive for TeleDoc because it opened up a lot of the MD Live client base of payers who were looking for a more neutral solution because they didn't want to be using Cigna as their virtual care provider. And so TeleDoc has actually seen growth, right? An uptick in growth and takeaway opportunity results from that move. Although a few may want this, more would prefer not to have all their eggs in the Cigna basket. He also mentioned that TeleDoc still provides multiple products and services to a lot of the parts of United. The next question by Lisa. Lisa presented 3 questions here. The first questions are there any pieces that are, number one, that are missing that you feel like, maybe you need to add or have an acquisition? Is there something else you have to build or to buy? Which I say both are actually the same question. Second question is, how do we think about that, meaning other possible acquisitions, all fits into value-based care over the longer term? And the third question is how that model changes for TeleDoc. Now, for those of you relatively new to investing in the healthcare space, value-based care is a form of reimbursement that ties payments for care delivery to the quality of care that was provided. It rewards providers for efficiency and effectiveness and that delivery of that care. Over the years, it has emerged as an alternative and potential replacement for fee-for-service reimbursement that pays providers kind of retrospectively for services delivered based on bill charges or annual fee schedules. The trifecta goal of value care is 1, better care for the individuals, 2, improving population health management strategies, and thirdly, reducing healthcare costs. Now, these things are based on specific measures like reducing hospital readmissions, leveraging certified health IT, and most importantly, improving preventative care. This all makes sense when viewed in context. When I talk about the first M in the DUMB method, which is M1 or management effectiveness, one of the metrics I discuss in depth in this part of the analysis is executive compensation, which is so important to understand when buying a company. Because incentives, they drive behaviors, and those behaviors may not always benefit shareholders as supposed. Think about it this way. In more traditional fee-for-service reimbursement models, the healthcare providers are paid for the number of services they perform. Makes sense. So if I increase the number of services I perform per patient, meaning more tests and procedures, and I manage quantitatively more patients, well, I get paid more without delivering necessarily better quality of care. Good for the doctor, well, not so good for the patient or the insurance company. It's not necessarily that the doctor cares less in most cases, it's just that's how the doctor's pay is set up. Incentives, again, drive behavior. There are always unintended consequences in business decision making. And that is why you want to make sure incentives drive behavior that have a more dispersed, distribution of both reward and penalty to all parties affected. To Lisa's first question, are there any pieces that are missing that you'd like, or at least feel like there might be a possibility of an acquisition here? Is there something else you have to build or buy? Jason responded with obvious answers, which is yes, where it makes sense for the company, clients, and members. Jason indicated that TeleDoc will continue to lean into the cardiometabolic continuum and that they continue to do that with the chronic kidney disease program that they launched last year, as well as the early stages of the congestive heart failure program, which TeleDoc built themselves. He also believes they can fill in the gaps in services through the right partnerships with some of the programs, as well as build out some new services like TeleDoc did with chronic health failure, and some additional acquisitions where it makes sense for members, clients, and the business. He mentioned TeleDoc launched a partnership with Fresenius on the chronic kidney disease front as an example. And lastly, the fact that TeleDoc brings things to bear that can have, the biggest impact for TeleDoc, both in terms of its outcomes for their members, but also the financial impact to the company. And to Lisa Gill's final question. And as a final question, Lisa targeted what's on the mind of most shareholders given the performance of the stock over the last 7 or so months. She asked, and I'm sure you're as disappointed as we are that the stock hasn't performed better. What do you think that ambassadors will appreciate then that they don't appreciate today? And hopefully that will be reflected in your stock price. Jason answered, one of our 7 company values is keeping our promises. He then iterated TeleDoc's ambitious growth targets for the company of 25% to 30% top line growth per year for the next 3 years on a $2 billion base, making it a point to say that he believes TeleDoc will be rewarded for keeping his promises when it comes to its financial metrics. He also stated how important it is for investors to see TeleDoc's continued progress in terms of its revenue per member and its product penetration or multi-product penetration, which I believe most analysts reviewing the company absolutely miss. Jason believes TeleDoc has laid out an opportunity that looks like $68 per member per month of total opportunity from the TeleDoc product portfolio someday, and that the company today is just north of $250. From a future revenue perspective, Jason is very bullish on the Primary 360 offering and continued progress of new products like MyStrength Complete. He felt the investor community will appreciate the return on the investments that TeleDoc is making in the product portfolio and in its set of capabilities. I've said this over and over in many of my other TeleDoc analysis and updates. This assemblage and build out of an intelligent health virtual care system, it's never been done before. They're literally flying this thing as they're building it. There are no roadmaps. They're creating them as they go. It won't be easy. There will be stops, starts, and restarts. But if they remain focused and committed to their vision, it won't only be shareholders that benefit. If you found this video helpful, click that on-screen thumbs up icon and subscribe if you haven't already done so you can get real investing information for real investors. Thanks for watching. I'll catch you in the next video.